Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, April 8th, 2025. Welcome back to the podcast, George.
Great to be on, John.
Good to have you, and really looking forward to this one. For our listeners' benefit, we're going to do a deep dive into tariffs. I think it's obviously topical, right? I think there's a lot to unpack. George, you?
Yeah, no, there's so much to unpack here, given the last few days of market price action, plus the news and the updates. It's hard to keep track, so I'll do my best to kind of walk through, but I think this is definitely timely to get through this topic.
Yeah, it's a lot to get through, but we'll keep it tight. So, George, before last week's Liberation Day announcement, where the Trump administration released the specifics on the tariffs, you published the Macro to Markets Outlook, titled "It's Tariff Time. Only time will tell the macro and market impact." In that report, you and your team provided some useful historical background on tariffs, a review of U.S. trade policy initiatives, and tied it all back to what that might mean for financial markets. As example, supply demand dynamics in US fixed income. So I guess the question is, now that we are post Liberation Day, why don't you give us a quick rundown of what's been announced?
Yeah, I'll go through that, and then let's also talk about how this might impact and how it may compare and contrast from the piece that we published, which we encourage our listeners to kind of go and look at that report, 'cause I
For
think it's
sure.
still timely from like a background perspective. But as we all know, things are changing pretty quick, and yeah, I think it would be useful just to kind of walk through what we know now and what could still lie ahead. Yeah, what we got on Liberation Day was the announcement of the further tariffs, where just kind of walking backwards, there is 25% tariffs now on autos. There's now a 10% baseline across all nations, not just those that have a deficit with the U.S. So even trade surplus countries, I think, are getting a 10% baseline, and that's for a lot of different reasons, which we can get into later. And the reciprocal, which I'm using air quotes if you can imagine, because it really truly is not reciprocal in the strictest sense of the word. Going in, many were thinking that reciprocal meant that if you tariff a country by 5% on a certain product or industry, that you would just match it at 5%, and therefore it's reciprocal, it's equal. But instead, we got the definition of reciprocal more around like bilateral trade and the deficit that the U.S. has with a certain country, and that really inflated it and became these really large tariffs that were announced. And the baseline again, the 10% is already in effect because it's April 5th is when they went into effect. And as of now, the reciprocal or these new larger tariffs go into effect on April 9th.
That was pretty comprehensive, but still honestly a little bit confusing. There's so many different variables there. But I guess what's more important is what are the goals of this tariff approach? Like what's the administration trying to accomplish? And then also what are the macro and geopolitical, implications, risks from them, developments that might lie ahead?
Look, this really could trigger a whole host of other unintended consequences, but the way to understand the goals is to think about why were they levied, or why are they being designed this way. I still think at the root, it's and this has been what many of in the marketplace have thought it to be a negotiation tactic, that these tariffs, regardless of how they're constructed, and this again really more of a heavy-handed approach, they're meant to be a negotiation tactic to try to encourage fair trade, making it more broad-based. Again, like countries that don't even have actual trade with the U.S. are getting it, or trade deficits with the U.S. are getting it, making it more broad-based. I guess, well, at least it's equal, or a baseline has been established of 10%. It avoids, I guess, arbitrage or getting around trade deals where maybe a country can like use a surrogate or a neighboring country to kind of get their exports to market and avoid, I guess, the tariff. I mean, I'm trying to think through like the logic of why it was done in such a broad-based and uniform approach, at least for the 10%. And then the idea of making it using the tariffs charged to the U.S. is that equation really comes down to very little to do with the actual tariffs of the other countries, but more to do with the ratio of the U.S.'s trade deficits to the imports of that country of U.S. goods, and doing it that way, I think is like a blanketed approach to cover the non-trade barriers, which are hard to pinpoint, like subsidies that are done to local industries and or FX market interventions that may happen that lowers the value of their currencies and makes it easier to export. I think that's the reason, and I think the way they were designed, and I think that's the goals are really to be so large in scale that it kind of forces everyone to the table. I mean, at the same time, though, there is a potential revenue benefit, I guess, if there, if we do start to see payment being made, and it's going to be interesting to see like who like I mean, ultimately it gets passed on, either could get passed on to the U.S. consumer, but it depends on if countries and companies on the other side decide to lower their prices and or if the currency adjusts. And so it's not a clear one for one, but I think that's the way I understand the goals and why it was designed this way. I mean, the macro and geopolitical risks are that some, as we're starting to see in the news come through, not everyone's going to play ball. And I think it could lead to escalations as we're seeing, especially vis-a-vis with China. But it might, bring some to the table, and that actually results in lower tariffs. And so I think it's not going to be a one size fits all, even though it's broad based. I think we're going to see these kind of bilateral trade agreements, and it does make it complex because in a way I understand making it broad based makes it sound simpler, but now you have to then negotiate like 150 times or 180 times. I'm not sure we trade with every 180 country in the world, but you have to do a lot more negotiations, and that might bog you down at the same time. So yeah, I think it's complex. It's not an easy thing. I think it's being made large and dramatic to try to get people to the table and negotiate. And the implications macro wise are, if you don't, the longer this persists, it does run the risk of being disruptive to global trade and to the global economy, but also it kind of feeds back into the U.S. and will weaken growth here because we're still a service-based, goods-based economy that gets a lot of our goods from overseas, and that means there'll be an impact to retail trade, and tariffs will hurt logistics and shipping companies and things like that. So, and basically all the trade companies. So there's definitely going to be an economic price to pay.
Yeah, and let's. I'm glad you mentioned that. That's actually what I'd like to explore a little bit more. So you had a house view on the economy, the Fed, inflation. So it sounds like you're still open to the fact that this could be a negotiation tactic. It could ultimately result in lower tariffs. But I guess has the developments of the last, let's call it, week impacted your more medium term view on the economy, the Fed, inflation, et cetera?
Yeah, no, I think it's worth just kind of reminding everyone just what our house view was, and just flagging that our 2025 outlook base case was that we were sort of anticipating the short-term pain for long-term gain, without obviously going through all the details that we know now, but the general ethos of uh, fiscal consolidation, the idea of cutting back on government spending, federal jobs, this tariff uncertainty kind of hanging over markets, and being potentially disruptive. Ultimately, all of this has the biggest risk, which is execution risk and the unintended consequences, which none of us can fully model and understand the consequences. And so, I think maybe it's gotten a little bit farther than what our initial bearish outlook was, which we thought that you were going to see this sort of economic weakness, a retooling, a restructuring of the economy. But if and this is where I'm using the word if a lot, and I think a lot of investors as well as corporate leaders are doing the same. And this idea that you're waiting to see, is it binding? How long does it take to get resolved? What is the kind of end state? What does that look like? What are the rules of the road? I think once business leaders and investors understand what the new rules are, they can prepare, and this becomes less paralyzing. But overall, this high levels of uncertainty reduces confidence ultimately, and that is really what most economies are built on the ability to kind of future plan and be able to grow your business and the economy ultimately. So this is maybe going further than what we were anticipating, but it's in line with the direction that we thought that we were going to see this adjustment process, which would lead to lower growth. Now it really does kind of open up the possibility for recession. I think we're in the midst of like stagflation again, or stagflation light environment. So we've increased our odds for, yes, we're kind of almost evenly split between staying within a stagflationary environment and or eventually falling into recession because this will just reduce activity. And the Fed in that environment really has a really to balance out its dual mandate between growth and inflation. And I still err on the side that push comes to shove, the Fed will do the right thing and will cut rates to try to kind of, as I've used this expression before, as you know, like foam the runway, try to provide some sort of offset to what's happening here. But we're not hearing it from them yet because they themselves too are kind of paralyzed by this uncertainty because the tariffs may be on and then maybe they'll be off. And so I think once we know for certain that this is going to persist in one form or another, and that there might be a kind of a split sort of implementation of these tariffs, and we'll see the consequences on the economy, and I think the Fed will react if that results in lower growth.
Yeah, so it sounds like, and this all is very reasonable. Sounds like you're saying the odds of recession. How has your view changed? The odds of recession have gone up. The odds of ending in a, or spending a lot of time in a stagflationary environment have gone up. You still think the Fed cuts despite some of that inflation. So just like you, as you said, directionally you were correct, but this was more than you expected. Markets also were not expecting such a broad and high level tariffs placed on all, particularly all countries in the world, including small ones, and that clearly caused shockwaves across, asset prices, really across the globe. Let's start where the volatility was felt the worst. Stocks have gotten crushed. The Nikkei, before last night was in bear market territory. I think in a matter of 2 or 3 trading sessions. I think it would be helpful for our listeners for you to play some context around the last few days of price action. It's been a while since 2020, '08, et cetera. So maybe we'll start there.
Yeah, no, and I think it's also important to set the stage of the last 6 weeks have been kind of a slide lower in risk markets in general, and this kind of was kind of like that final capping stone of added uncertainty that just resulted in a severe de-risking. If you look at up until basically the beginning of March, and then throughout the course of March, the markets were in between 5 and 10% lower, looking at the broader equity markets. But then we got nearly a 10%, well, actually, roughly about a 10% or so move in 2 days at the end of last week post Liberation Day announcement. And that 2 day move is definitely for the record books. It's on par to the sort of 2 day moves that we saw in and around the COVID shock back in 2020. We had similar days like this during financial crisis. So it's definitely in like the top three most extreme outcomes for the last 30 years. I mean, it really even surpasses the days that we saw during like long-term capital in the Asia financial crisis back in the late 90s. The U.S. credit downgrade in 2011. There really isn't other events that are really comparable. And it kind of goes to show you that markets were hoping for a better or less severe tariff announcement, number one, but also markets have been of the view that they've kind of buy dips and usually things have kind of gone up and to the right for so long now that investors haven't really seen this sort of volatility. And so I think that it maybe amplified the de-risking. Not to mention there's a lot of leverage within certain sectors of the equity complex. At this stage, you would think that a lot of that's been cleaned up, but then you get to, we're recording on February 8th, and like there was an attempt for the markets to kind of claw back, and we'll see how the day closes. But nonetheless, I think that a lot of damage has been done, that you've had a 6 week or so period of full retracement and breaking from the trend of this up move that we've had in equities, a pretty big outside quarter ending as well, where you had a higher high made than a lower low made in the same sort of quarter. Doesn't usually bode well for equity markets. And so, although we probably are in oversold conditions, it's just hard to see the catalyst other than if the tariffs completely were to go away. And even then, I think a lot of damage has been done to the psyche of the risk markets.
Yeah, it sure has. I mean, the move's been, the move's been big. I think, with the Nasdaq's down like 19% or something like that, right? I mean, it's just like a massive move. So we talked about risk assets. There's also been a pretty significant price repricing in U.S. fixed income. I think we're pricing something like four rate cuts into this year and an additional five through the forecast horizon. So it's pretty significant. If I'm not mistaken, I think we were really only two cuts, heading into this, but not, and it's not only fixed income, it's credit, G credit, high yield credit. Take our listeners through how those markets have reacted, how yields have changed, how spreads have changed, what that tells you about how markets are reacting to this, and what that tells you about, what could happen, over the next, month or so.
Yeah, I'll start with the most extremes, kind of following along from what happened in equities. I mean, the next up was really high yield, breaking clearly above 400 and making a move towards 450 on spread on the OES spread. It yeah, there we came into the year with spreads sub 300,000 or like sub 300, and yeah, kind of clawed back higher. And this happened where it was pretty much instantaneously over 3 or 4 days. I think that there too, it's going to be hard to see a full retracement lower in spreads, and maybe that's the range now is somewhere in the 3 to 400 range if we can find stability in spreads. Um, and a lot of the companies within the high yield sector are associated with like the Russell 2000, smaller to mid cap companies that are at risk of pretty big disruption to supply chains and and plus energy. So a lot of things happening there that could amplify what's happening in the leverage space. But even IG had a decent move too. Again, IG also was sub 90 for quite some time. People were saying that you're buying credit because of the all-in yield effect. Well, I guess that means when the underlying benchmark rate like treasuries rally, IG won't rally as much because if you're buying it just for yield, then you want to keep that protection. So spreads are going to naturally widen. I think that's largely what's happened. So IG has had a hard time keeping up with treasuries and back north of 100 basis points. And I think that's probably the right level. So we had the initial range of like 9110 as a kind of a fair value for IG. So it popped back into the range. And I think it's going to go beyond that. So we now have a new kind of at least a new baseline target of like 125 in IG, and we'll see if that holds. And then, the one that's market that's been kind of relatively taking this relatively well has been mortgages. Mortgages were reacting to other news outside of the tariffs. And so mortgage spreads, although widened as well, are still within our 125, 150-ish kind of range and should kind of still benefit from like flight to quality, just like treasuries do. And then for treasuries, the 10-year is what's been the most interesting. Although, there's a lot going on in the front end, which is naturally kind of tracking those rate cut expectations that you mentioned, 4 to 5, who knows? But the 10-year, the inability of the 10-year to really rally as much or hold on to the rally gains, I think that was the most interesting. And then that ties back to, one of the pieces that we covered, one of the topics that we covered in our piece, which is that, if we're really reordering how global trade works, it will also impact capital flows in the U.S. Bond market, both treasuries, credit, and also mortgages, benefit from the recycling of dollars that are overseas. And if we start to see less either demand for our fixed income, it's going to be because our foreign investors are either pulling back on capital and or there's just less dollars to reinvest. And so I think that the bond market's kind of picking up on some of that, and that's keeping a term premium within the 10-year and holding it back from really rallying. I think if we do go into a recession, I think all rates will rally. But at this stage, I think it's really causing kind of a resistance on the 10-year to stay under 4%. But we'll see. And I guess on Fed policy, we kind of touched on it. Our view, has been 2 to 3 cuts. We have not officially changed anything. I think that hopefully cooler heads prevail in the coming weeks. But I'm much more sympathetic that if we go into a bigger slowdown, that the Fed's going to have to deliver more than just that.
For sure. And just back to that kind of, foreign sponsorship for treasuries, we just, as you said earlier, it's Tuesday, April 8th, and we just got the the results from the 3-year note auction, and direct bidding, which could be a proxy for larger foreign appetite in the auction, was a mere 6.2%, which was interestingly enough the lowest since 2020. So perhaps just a function of the market volatility, but perhaps a function or a symptom of appetite for U.S. debt, in the context of this trade spat. So obviously only time will tell there, but certainly something to watch for. And then the other thing I just wanted to highlight for our listeners in the monthly, again entitled "It's Tariff Time, Only Time Will Tell: The Macro and Market Impact." There's some really great charts that kind of visually show those ranges that George is talking about. And again, if you are still not receiving George's strategy reports, do check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered into your inbox. Great stuff as always. Thanks, George.
Thanks, Sean.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.